Good morning. It is July 5th, 2019, the day after Fireworks Day, Freedom Day, Independence Day. And we're going to do a bit of a first year review, but more of a second half of the year preview. Focus on some macro, focus on the Fed, and talk about some key topics that we are investing in. I think this will go pretty smoothly, pretty quickly. And if you have any bigger questions, start putting them in the chat, and I will get to them near the end. Or if I glance over and it happens to be on topic, I will, try to add a little something there. So for those of you who are subscribed to Margin of Safety Investing over at Seeking Alpha and Fundamental Trends, which is the standalone letter that focuses a little bit more on trading and growth. You have seen this year with the additions of Dividend Sleuth, which is Ted, and Dave Zanoni, who's more of a growth guy, that we have been doing a lot of overviews, a lot of research on companies. This is just a couple of months really hitting our wide universe of stocks. I've got about 20 updates to add to fundamental trends here over the weekend. But really there's quite a lot of material. So what I really want to talk about today is how do we pick what we're going to invest in, what we're looking at, why we're looking at it the way we're looking at it. And to consider something that I've said over and over again, which is avoid the middle of the market. When you don't know which way things are going to go, if you're in a situation where something could either go up or down, try to avoid it. And that's easier said than done, right? We have invested in things that we thought were deeply undervalued, and they continued to go down and become more undervalued. And that is why when we scale into a position, we're not looking to buy every time it drops on a day by 1% or 2%. We're looking for those larger irregularities in prices where a stock might drop 10% or 20% or 30% or 50% over a number of months. That, of course, happened with oil stocks that I thought were undervalued and ready to turn up. We ran smack dab into the divestiture movement in a thin market that just doesn't favor oil stocks right now. And a lot of oil stocks dropped a ton. So, that's a market that we're waiting to come back for us. And at some point, it will. But managing option positions with deteriorating time value makes it a difficult proposition. So at the top of the hour here, I would just tell folks, look, be careful when you're scaling in. Take your time. I like to sell puts if you have a large enough portfolio to do that. Selling puts a month or two out to create a de facto schedule, a spread out scaling in schedule, I think is a smart way to go. Many, many times I will buy a stock. For example, I bought some oil stocks in November of last year, and I sold puts for December and January. And then I got most of those puts assigned to me. So I would collect that 10% premium and get the 5% or 10% drop in price from the put assignment. Of course, those stocks had dropped 20 or 30%, so I was underwater. However, because I did it that way, spreading out my buys by a month or two, I didn't make the mistake that I think some folks made, and I share some blame for not being real clear on this, that they bought a stock after it went down 2 or 3% a week later. 2 or 3% is volatility. It's not really a price move. It's just choppiness. If you're not a day trader, right? If you're not a day trader or a really short-term swing trader, those 2 and 3 and 5% moves are inconsequential. That's just noise. That's just volatility. And in many instances, it's a signal. And sometimes it's a signal that we miss. And with oil, I just really didn't think that it would get beat up that bad. So how do we fix things? Well, there's a piece of wisdom that you don't always have to make your money back where you lost it. And I think that that is sensible for a lot of us who have a quarter of our money committed to the energy sector, is that rather than expanding our holdings in the energy sector, we look for other opportunities so that we remain diversified. And we'll just have to spend some time letting the energy sector come back to us. And we'll talk about some reasons why that will happen eventually, but it still doesn't feel good now. As we look forward, we want to focus on companies that are going to do well for us. And the dividend 30, which is, this should actually say dividend growth 30. I probably could correct that right now, but I won't. These stocks that we have put here, and I made this public, so I'll show you. These stocks all pay nice dividends, increasing dividends, and they have growth. And it's important for a dividend stock to have some growth, because otherwise the dividend won't grow without financial engineering. And that is something that I think many, many dividend investors miss. And I think whenever the next serious correction occurs, and even the smaller corrections that will represent rotations away from certain stocks, your dividend stocks in the S&P 500, as we've covered before, about 1/3 of them have seen increasing dividends strictly from financial engineering. And by financial engineering, I mean they have borrowed money in most cases to lever up their balance sheet and keep the stock price going up, because the rising dividend, attracts investors. And then you see the corporate executives make a lot of money. One of the harbingers, one of the telltales that I've seen over my career, which is 25 years now, plus internships and part-time jobs while I was in college, so really about 30 years, is that when corporate executives start to sell, you better watch out. And I don't just mean the diversification and tax strategies that many executives have. They have programs where they will slowly sell shares on a schedule over time. Now, I mean when those plans get ramped up, right? And it's not just selling 5 or 10% of their holdings over the course of a year, but when they're selling 20 and 30 and 40 and 50% of their stock holdings in companies that are granting them shares as compensation, you better be careful. And we're seeing more and more of that now. Certainly there's some corporate buying going on by executives, stock buying by executives, but by and large, executives are selling, and they will probably be selling more next year if they fear their tax cuts will go away. And I have speculated and estimated that that should be a legitimate fear for them, because I do think the Democrats will gain seats in the Congress. I really think that they're likely to have the next president. And that means that if they're smart, and I say that with a grain of salt with any politician, if they're smart, they won't talk about raising income taxes. And in fact, I don't believe income taxes should be raised. I think that there's a lot of people that understand that high taxes are bad for the economy on both sides of the aisle, and a smart strategy for the Democrats. And I believe that things that make sense eventually happen. So I think a smart strategy for the Democrats would not be to talk about tax increases in particular, to specifically say that they're not going to raise income taxes. This AOC stuff of marginal income tax rates at 70%, it's just stupid. you crush the economy doing something like that. But to get rid of some of the tax breaks that real estate investors have, and to get rid of the carried interest credits, to raise the capital gains tax rate to just be the same as income tax rate. Whether you make your money as an investor or an employee, it all gets charged the same. Those things seem to make sense. And from the macro and government policy perspective, which we use, right, the Core 4 approach, theoretically I'm supposed to rename that in case I run into copyright infringement. But, we look at macro and then we look at government and central bank policy. The coming government policy, you can really throw the politics out a little bit, is likely to include higher taxes, particularly on capital. Why? Because we haven't seen wages go up for employees relative to inflation in about 40 years. That's a long time. And in the last year, we finally saw a little uptick in wages, but not much. But what we really have seen is this weird millennial approach of living way beneath their means. And I say weird, and I say millennial approach because I'm going to exclude the couple of million millennial men who just refuse to work. The millennials in general are driving the economy now as it shifts from boomers, passes through the Xers like me over to the millennials. And they have the FIRE strategy, very many of them, right? I forget exactly what that stands for, but the RE is retire early. And they do it by living dramatically beneath their means. So they live in cheaper houses, they move to the edge of good neighborhoods, and they gentrify those areas. I'm seeing it in Milwaukee. I was just in Vegas and I was seeing it. I've been out east. I've been in cities and states pretty much everywhere except Southern California, which you read about. And I haven't been in the Pacific Northwest in a few years. But I've been over the rest of the country in the last 2 years. And what you're seeing is the millennials find pockets in cities and on the edges of cities where they can take a neighborhood that maybe used to be nice, and they can go in there and they can invest in a building in a neighborhood that they consider up and coming. And this has really been an amazing thing that's been going on. I'm looking at two of those neighborhoods in Milwaukee, and yeah, somebody mentioned Portland. Portland, I was there several years ago for my brother's wedding. I think it was 4 years ago, and somebody walked us around the city and said, "Look, this used to be an industrial area that fell apart, and it was full of shops and voodoo donuts and all sorts of neat stuff." And they were adding loft apartments and condos. So the redevelopment of urban centers has really started to hit the peak of the cycle, to be honest with you. Prices are sky high in a lot of places now. So the millennials, I think, have actually done pretty well with their money because they have done something that a lot of people have talked about for a couple generations, but not done, which is live beneath their means. It really has become a millennial rallying cry to not spend all of their money on toys in particular. They really have embraced the sharing economy and the gig economy, and they have transformed the investment landscape, not only in real estate, but in the stock market. That's one of the reasons why oil stocks are just have fallen apart. I think they're at terminal value at this point. If they go lower, it doesn't make sense how low they are now based on future earnings. But when you take a look at investor sentiment, particularly the millennials who just completely ignore energy stocks at this point, it makes a lot of sense. So how do we adjust to a changing world? Well, we have to look at the very long-term trends. And as Stanley Druckenmiller said in an interview a couple of weeks ago, he said, invest in the disruptors and sell the disruptees. And that is something that we are going to focus more and more on. And that's what this dividend growth stock is. Now, we have a retiree low volatility dividend list, and I'll have the sustainable growth stock list out in July. I've been working on that for months. I choose not to release it piecemeal, although we have, about 15 stocks that, we already know. I'll be adding about 15 more here this month. So when we take a look at these stocks, we think about what are the stories here. And you take a look at Apple. Well, Apple has both hardware and software and is adding services. And this is the company that I tell people to invest in if they talk to me about banks. If you like banks, you should like Apple better. Why? Apple has more money than the banks, net, and they have less risk. It's pretty much that simple. So Apple has more growth than the banks. They are less recession sensitive. They're adding revenue streams as the IoT and more services, online services, continue to come online for music, for news, for movies, for smart home. They have a whole division on self-driving cars, which they'll either license out or maybe they buy a sled. Maybe they buy an electric vehicle car maker. Maybe they get a license from Tesla to use the base of the car. That's called the sled, with the battery pack and all the mechanicals, and then you put whatever kind of cabin above it that you want. So Apple is really a leader in all of these new consumer trends. So if you want a bank, you might as well buy Apple with its billions and billions of dollars on the balance sheet that they can use for almost anything. They're incredibly sticky, affluent client base, right? People say, well, Samsung has 75 or 80% of the cell phone market, and Google's actually been eating into Samsung because the Pixel, like I said, is a pretty good phone. But Apple, they don't really compete with Samsung. They just have their niche. And it's 15, 16, 17% of the global population, of the cell phone owning population in America, and it's lower, like 10 or 11% internationally. And it doesn't go away. So I have an Apple, right? I have iPhones. I switched to iPhones back when the iPhone 5 and the Samsung, whatever they called theirs, it was a 5 as well. So I compared them, and I didn't like the bloatware on the Samsung. It was clearly I could do more things with the Samsung, but I didn't want to do more things. I wanted it to be easy. I wanted it to be intuitive. Apple was easy and intuitive. Now, could I program the Apple the way I could program a Samsung? No. Did I care? No. And most people don't. So a lot of Samsung customers are going to gravitate towards Google. I'm telling you that right now. The Google Pixel is a better phone than anything Samsung has. So, if you like the Android system, you like a little bit more freedom, but you want less bloatware and you want a little bit better technology and maybe save a couple bucks because there's no middleman, I think Google's going to eat into Samsung, but they're not going to eat into Apple. So Apple has a very solid customer base, and they're adding services and revenues, and they're super rich with essentially no liabilities. So if you think a bank is a good idea, why wouldn't you go with Apple that has a better debt profile, a better balance sheet, better growth, and avenues into the future? And by the way, Apple buys pieces of other companies and loans money to other companies. So, I think the folks who have talked to me about banks recently, you should have talked to me about banks 7, 8, 9 years ago when I said to invest in Bank of America and Wells Fargo and JP Morgan, Wells Fargo, even though it's gotten beat up in the last couple of years, still way above where it got down to. But JP Morgan, Bank of America, US Bank, all of these other banks have really killed it. And you have to ask yourself the question, is the bank index, anybody remember the symbol? For the bank ETF. We'll find it, whatever. I mean, we can just take a look at Bank of America. 10 years. We can go a little longer. You have the crash here, and they double bottomed. If you wanted to invest in Bank of America, you should have invested down here, or when it started its breakout about here. What's the point of investing here? Do we really think it's going to double again? I don't know. I think this is the perfect example of the market in the middle. Which way are these banks going to go? We know the interest rates aren't really going up anymore. So that's a catalyst they don't have. Back in here, when President Trump was elected, everybody figured that interest rates would go up, and he got this big rally. And now we're at this point where interest rates are no longer going up. We had another inversion of the yield curve, and it doesn't go anywhere. I think that these banks could all chop around for a long time, and if a recession hits, get all the way back down to these support levels right about there. So an $18 price on Bank of America, I think that's very likely at some point. And could it get back up to 40 or 50? It could, but that might take a really long time. The normalization of interest rates might be an entire generation away, literally 20 to 30 years before we see interest rates at 5 and 6 and 7% again. So, and that's what would make the banks very profitable. So I would rather have Apple. Going down this list, there's similar stories across the line. Many of these companies are taking part in the disruption of the economy of different sectors. Take a look at BlackRock. I'd rather own BlackRock than any bank. Better balance sheet, fewer liabilities, more growth, the move into passive investing, right? Millennial driven. A lot of smart everything world in here. Disney. When we put Disney on this list, it was like 110. Now it's 140. Right? Adding subscription revenue. One of the ones I've been on since it's been about 30, 31, 32 is AT&T. It's finally starting to show signs of life as they shed debt, as they add streaming income, and they add advertising revenue. One of the things that's going to impact Facebook in particular is how they use data to advertise to you. And basically, they'll keep it. Thank you for those symbols. Basically, you're going to have to keep your data in-house. Sharing data with outside advertisers is going to become more and more difficult based on regulation. So the companies that can use the data in-house, like AT&T, are going to do pretty well. Google, one of the complaints about Google is that they're starting to dominate the search with their own content at the top. Well, building a search engine isn't all that hard, to be honest with you. Google dominates the space because their algorithm is a little bit better, but really they had first mover advantage and people just call it Googling. So could you go to Bing or any of the other search engines and get very similar results? You could, but people don't. So what is really Google's strategy now that they can get competition? Put their own advertising at the top. So anytime you search Google, restaurants near me, right? What's at the top of this page? This is Google, right? Then you get to TripAdvisor and Yelp and OpenTable. At the top of the page, Google. Then you click on this, you're in Google Maps. Okay, let's take a look at Mickey's Family Grill, which I have no idea how it gets 4.4 stars. I've been there. More Google reviews. Remember when there was was it called local.com or city something? I forget what it was called. But there were websites that would do the local searches for you. When you search on Google, you don't get those websites at the top of the page. You get these. So this is Google keeping the data in-house and keeping it on their pages. You click on Olive Garden. You go, oh, look, there's an Olive Garden in the neighborhood. You just click that. That's an ad. They just made a penny or something. So Google isn't the one that I worry about here, but I worry about companies like Facebook, and I try to figure out, okay, as Facebook loses revenue or has their revenue flatten, who's going to take that, to take some of that revenue? And it seems to me that AT&T's on that list. Google probably, as they shift to dominating the top of the pages more often, they're going to be on that list. Because how can you tell Google you can't share data, but you can't put your own stuff at the top of the list? They might just start telling people, hey, we're proprietary. The stuff below what we put up there is, extra. And if you want to have a different search result, go to Bing. Go to one of the other ones. Bing is actually not so bad. So let's keep in mind how the economy is moving and which companies are eating some of the lunch from other companies. All right, let's move into the news a little bit today. Actually, not quite yet. Next. If you haven't been to Crestmont Research, I encourage you to go. Incredibly good website. Their new articles are always thought-provoking. And these two in particular, I think, are important. So the first one is, what can we expect for returns over the next decade? And they're saying U.S. should not expect more than 6% annual stock market returns. I take with a grain of salt what analysts say because they've proven to be wrong over and over and over again. What I think is most important is as we shift down here and we take a look at, okay, how are we going to make the money? Is we have to realize that there are big realignments in where profits will be found. And again, that goes to what I said a moment ago, which is you want to invest in the disruptors, not the disrupted. So when we look at dividend growth, we want companies that continue to grow, improve their balance sheets, don't get too levered up, and have secular trends on their side. That's always important. And we have to keep that in mind because some of the old man stocks that I talked about 9 months ago have gotten beaten up. We can take a look at, I think we could just take a look at Altria. They haven't gone anywhere in the last year. I was telling people to sell this. Nobody wanted to listen. I was stupid. Everybody's going to keep smoking. They're going to get into marijuana, and they will get into marijuana. But I'm telling you, I have actually done quite a bit of research on cannabis, and we'll be getting some articles here lately or soon. Is I don't think Altria is going to dominate that space. I think you're going to have a lot of small brands that do very well for a very long time, and you have to think about what companies have scale without having a lot of expenses. And some of these outfits in Las Vegas, I tell you what, man, the business model that I saw at a couple of dispensaries and the products they were selling and how they filtered people in and out, they're printing money. So it really just depends on, are they going to pass that through to shareholders, or do the executives and the big shareholders eat all the money? We'll see. A lot of times companies IPO and go public as a way of cashing out, or a way of, for the executives and the early investors to cash out, or to raise money from the public that, that they're basically going to transfer to themselves through the revenue of the company. So they IPO, they invest in the company, but then they take such exorbitant salaries and stock bonuses that it never really finds its way back to the shareholders. So a lot of times IPOs, frankly, they're scams. It's a way of transferring your money to a company to the executives. And that's what I watch out for. I really like the business model of some of these companies, but I'd probably get paid better if I found a way to be on their board of directors versus being a shareholder. And that's what I'm looking for. I mean, I think there's going to be winners in cannabis. People have wanted me to talk about this, but I think it's going to be hard to find them. And I don't think the big guys like Altria are going to do all that well. And now that they have their e-cigs, their vapes getting attacked by regulators, it's going to be a tough road for a lot of the old man stocks. So now let's go over to U.S. hiring. Hiring was a little higher this month than was expected, but the last couple of months it was lower. So is that just ebb and flow? Is that just the analysts not being able to understand the kind of fits and starts that go along with hiring? A lot of hiring happens right after graduation, and that could be going on right now in June. So we'll see if non-farm payrolls continue to rise by around 200,000 jobs per month. Right around 200,000 jobs per month, plus or minus 20 or 30,000. Those are really good numbers. And if those are accompanied by wage increases, then that's really good. What's interesting is we added jobs, but the unemployment rate ticked up a bit. This is not really a big deal. This is just vacillation. It's just a little bit of volatility in the numbers. This is the one we want to keep an eye on. If we start getting numbers down around 72,000 like we had last month, then we're in bad shape. But the economists were expecting 160,000 jobs this month and last month. So 320. 224 plus 72, right? It's right on the nose. A little bit low. Not much. So if the next couple of months look like this, then we're ahead of schedule. If the next couple of months look like this, then we have to start thinking real hard about whether the economy is continuing to grow. And if the numbers are closer to this, then we, then we're just kind of running in place. And that's okay because things are pretty good. So then it comes down to our wages increasing, and that's good, right? So that's good for the middle class. However, we're starting to put pressure on corporate profits because wages are rising. One thing to keep in mind is that if it looks like corporate taxes are going to go up after 2020, that would probably be pretty bad for the stock market. I'm a believer in low corporate taxes. Why? Because all costs pass through to consumers anyway. So I like low corporate income taxes. I just like to see them required to provide certain levels of benefits and security to their employees. Within reason, you don't want to bankrupt companies. So if we can keep low corporate income taxes, we could probably see wages continue to drift upwards because that is almost a direct transfer of the low income tax rates getting sent to executives and employees and shareholders. And that's good. That helps propel the economy. It helps people afford houses. Um, I'm not of the opinion that we can tell people how to spend their money. And that's one of my beefs with the Democrats is that they try to control things a little bit too much economically, it seems sometimes. The reality is that they've been a little bit better at avoiding big problems than the Republicans, who have presided over a couple of really gigantic recessions. So we'll see where we go after 2020. I think the market, and where I'm coming here, is I think the market's going to be choppy through the election. I think that there's a lot of folks who believe that President Trump will lose, and they might act one way. And there's a lot of people who believe that President Trump would win again in a similar fashion as he did last time. And they could be right. The economy's good. Like I've said, he's got a pretty good chance if the economy's good. I've been expecting a little bit of an economic slowdown next year. I've said a mild recession with a stock sell-off. And we'll see if I'm right. If that scenario plays out, if the Chinese keep stretching out potential trade deals, if they're willing to inflict a little bit of economic damage on us and absorb some themselves, President Trump has a problem. So we'll see. If energy prices tick up in any meaningful way past $70 or $80 a barrel on oil, then that becomes an economic headwind as well. Less than $70, $80 a barrel don't much matter to economic growth. I paid an extra 15, 20 cents to the gallon, I think, compared to before I went to Vegas a month ago, yesterday. So, is that going to deter me from driving much? 20 cents a gallon? I don't think so. Even if it went up another 20 cents a gallon, I don't think it matters. Most of the studies have shown that until gasoline hits about $4 a barrel or $4 a gallon, people don't change their behavior. And now that we're going into the summer drive season, I think it's almost too late for people to change their behavior. So I don't see rising oil as being a big problem for the economy this year. However, we'll see about next year. We'll see if oil can regain some footing. And I'm talking about oil in general versus oil stocks. It is really hard to tell at this point, given the rapid change in the economy and the way that energy works. So if you ever get a chance, go over to Wells Fargo. They have really good reports. So Wells Fargo, hit the commercial tab, and just go to weekly economic and financial commentary. You find some pretty interesting stuff in here. So in their mid-year outlook, which is a couple weeks ago, we didn't cover it. They talk about their outlook on certain investments. And some of it I agree with, some of it I don't. But they point out some things that I've talked about, which is when we have volatility, take a look at your asset allocation and make some changes where appropriate. We can reduce volatility with income-generating assets. But remember what I started out with. We have to pick our income-generating assets very carefully. Some of these high-yield stock letters are really high risk, and they don't share that with you. So I know that we have some big investment letters at Seeking Alpha that talk about high-yield investing. Tell you what, take a look at what happened in 2008 to those types of investments. They didn't drop 50% like the rest of the market. They dropped 70, 80, 90%. Why? Because a lot of them took a step towards bankruptcy and reorganization. A third of the dividend-paying stocks in the S&P 500 are in that category. Big, big risk. And we have to be careful about that. Companies with a lot of debt and limited growth or no growth, that you should cross them off your list. If you have dividend stocks and you go, oh, well, it pays me 7% or 8%, and I love that, go take a look at their balance sheet. How levered up are they? And if they have zero growth or 1% growth or anything below 2% growth, you ought to just get rid of it. Sell. It's high right now. Sell it. Unless you think there's some catalyst for them to have growth. But a third of the companies in the S&P 500, I don't care if they're paying a big fat dividend, you ought to be selling them. Use cash share advantage. That's something that I've talked about over and over again. That's why we have our most aggressive portfolios are still around a third in cash right now. Consider greater exposure to emerging markets. So a few of you asked why put Malaysia on the ETF asset allocation. Malaysia got crushed, right? They had a lot of scandal. Their economy took some hits. You just saw a headline that the son of the former prime minister just got indicted on like $1 billion money laundering scandal. $1 billion out of their central investment fund, their sovereign wealth fund. So Malaysia was one of those stocks that just got beat to heck. And with the trade policy putting pressure on China, that opens up other investments. I went to Malaysia because they were more beat up. People asked me about Vietnam, and I said Vietnam could be something at some point. But I knew that Vietnam was a potential target of tariffs from President Trump, because I knew that China was probably, and South Korea were probably transferring steel through Vietnam. And it turns out that's exactly what they got caught doing, and that's what those punitive tariffs were last week on Vietnam. Now, Vietnam, we can take a look at their fund at this point maybe is becoming attractive. So it's come down off its high, not much, 5%. If it gets back into this area, right, then we probably look at it. So I bought Malaysia. Where's my Malaysia fund? There's a lot of symbols out there. I don't remember them all. There we go. So we bought Malaysia right down in here. It's up a little bit, just a couple percent. These last 3 months, I did it 3 months ago. So Malaysia is starting to outperform. I think, get that out of there now. Vietnam, 5-year charts are pretty handy. This line right here, where it rises, it falls, it rises, and then it finally breaks out. You see these patterns over and over again, right? And then the breakout. This level right in here, a little over 15, is probably a pretty good buy price. So if the Vietnam fund gets into this $15 range again, see how it held right there twice? This is a pretty good support level. Right around there. Lower 15s, approaching 15. You can be greedy and put in a $15 strike price. I think Vietnam is probably pretty good right at 15, and you throw 2, 3, 4% of your portfolio there if you want. I'll start with 1 or 2% and then see how it goes before I ramp it up. But India is also going to be on that list. Then finally, Wells Fargo talks about add strategies that can benefit from various market conditions. Well, the selling puts. If you can sell puts, $15 put, and collect some money, you're going to do pretty well. So selling puts to support levels is a pretty good strategy. You collect income. If it turns up, it just expires and you get to do it with something else. And if it doesn't expire and it gets assigned to you, you end up getting a cost basis below 15, which we think is pretty good support level. Top-down charts, I will tell you to follow this guy. I don't think there's a lot of great advice here, but the charts are pretty interesting and they make you think. And his mid-year review is pretty good. I look at this almost every year. And he talks about deflation risk, and I don't think he quite understands it. He's almost there. But deflation risk is there for three reasons. The whole slow growth forever thesis that I've been talking about since 2014-15, which is the combination of demographics, huge debts, and the change in technology. These are all deflationary or disinflationary forces. And they're not going to change anytime soon. Global debt's not going to suddenly go away. Even if we print hundreds of trillions of dollars globally through the big central banks, it's not going to go away. And technology is not going to slow down. We have bigger and bigger changes, and that's the last topic we'll get on. And demographics change very, very slowly, right? You know, some of these people will say, well, we'll just have more babies and we'll fix demographics. Yeah, it still takes 20 to 30 years. You know, so, you know, we'll see if people start to recognize the slow growth forever world. Think about the Federal Reserve. You've heard them use the word transitory in regards to inflation multiple times, from Bernanke to Yellen to Powell. They're all wrong. And the only guy in the Fed that I think keeps hitting it on the head is Neil Kashkarian up in Minneapolis. He talks about why the economy seems parts of it go one direction, parts go the other direction. You know, the whole disruptor and disruptee thing. Wells Fargo talking about the shift in profits from one sector and one company from a different sector and a different company. There's a lot of rotations. We have to find the spots in the growth. Zacks research points out that if you can avoid the bottom half of the sectors for economic growth, your portfolio performance generally will go up between 50 and 80%. It's a big deal. So just avoiding the no growth sectors is a big deal. And that's where we want to be. Thing about certain sectors is that they have both. Take a look at industry. Industry is usually a leader over time, but you want to be with the companies that are improving their processes and their margins versus the companies that are not improving their processes and their margins. Many times, companies that are high debt can't afford to improve their processes, and therefore their margins just continue to get worse and they become unprofitable. And that's that huge negative feedback loop that they can't break out of without getting taken over. And many times they don't get taken over at a premium. They get taken over at a lower price just to survive. So again, we have to find the parts of the economy that are growing in industry and see what tech is doing to help them. When we look around the world, we see that this chart, the PMIs are not doing so well, right? So developed economies are doing really poorly, falling off a cliff almost last year. Now, does that mean we're about to get a rebound? Maybe. You know, we could go further down. But I think over the next decade, and Wells Fargo talks about it, and this guy talks about it, to me, it looks like emerging markets, certain emerging markets, you know, either young educated labor or emerging markets that have the ability to produce without importing a lot of inputs, countries that have something to export on the natural resources front. Those are countries that are going to do well. And if I had to write a thesis, and I'm actually going to do this in July, I would say you primarily want to invest in the United States and several emerging markets. I think that Japan and China and Europe, for the most part, you can ignore except for a handful of investments, right? We like Alibaba because of the expansion of the cloud in China. Maybe we like Tencent at some point, but it's a hard company to figure out. I can't think of a Japanese company I like. Maybe Sony. Maybe if they do something with their studios. You have to take a look at these companies as companies, not just, box scores. Take a look at the makeup of the roster when you take a look at a company, So if you were a kid and you grew up looking at box scores in the paper like I did, that was one thing. You got the stats down. But then how do you figure out who's really going to win? You have to take a look at how many AAA prospects are likely to be real big leaguers. And that's the same thing with any company. You have to understand what's going to drive growth and performance. And I don't think we're going to see a lot of growth or performance out of Japan. They have problems with resources. They have problems with labor. They are one of the economies, though, that will really benefit from machine learning and robotics because they're going to have to. They're going to be forced into that. So, not a big fan of Toyota. Somebody mentioned Toyota. Not really, no. I just think the car companies, with the exception of Tesla, they're fighting with each other. Tesla is the only one with its own niche. They just did a record quarter. Granted, they pushed some things through the chain, but once they start selling in China, those numbers get bigger, and they are already borderline profitable. So, sometime in the next year or two, Tesla becomes profitable, and a stock that can go to 1,000 or higher, I think, is pretty exciting. We just hit that bottom that we talked about, that 150 to 180 range, and it bounced back up. Now, will it go back down to the 150 to 180 range again? I sure hope so. I'd like to buy more. But at this point, I have like a 228 cost basis on Tesla, and I won't sell those shares. Now, I did sell some Tesla puts at 200, which are finally profitable. And I'm trying to see where's Tesla. Tesla's 231 today. So, no point in me scaling into Tesla because it's about what I bought it at. I sold some of those $200 puts back when it was around $200, and that looks like a good trade. So we'll see. But developing markets versus developed markets in general, we probably want to look more at emerging markets finally. About a year ago, people were talking about emerging markets. I said, it's still early. Let's wait. And now I think we're at the point where, right, you're starting to get these, you got all these major support points. You got the double bottom in emerging markets. We need to start looking at these more seriously. So I think Vietnam is coming to us. I think Malaysia is still a buy. We'll probably want to take a look at Brazil and a couple of other countries. Global cyclicals versus defensives. You guys all know my theory on this, I think, is I really don't like defensive stocks in general ever. I'd rather have cash than defensive stocks. Because if there's an argument for being in defensive stocks, there's a stronger argument for being in cash. And something that, I was told at that traders conference is, what, if you think it's going down, just get out. So if we don't think cyclicals and consumer goods are going to go up, then we just get out and we wait. We wait for a correction. Because every chart you ever look at, defensives lag over virtually every time frame. And the time frames they don't lag are short-lived and they still lose. Global monetary trends. Okay, so let's talk about the Fed. The biggest mistake people are making is talking about interest rates. That's not a big deal. Granted, they're trying to get the yield curve to not be inverted so that people stop talking about it. So we'll probably get the interest rate cuts, 2 of them this year, July and December, maybe something like that, of a quarter point each time. Why? It's not real. It doesn't really have anything to do with Donald Trump beating on them. It has to do with the inverted yield curves. They want to get rid of that. And why are the long-term rates low? Slow growth forever. The big investors know the slow growth is a very long-term thing, having to do with the demographics, the debt, and the technology. So we're not going to see 5, 6, 7% interest rates for a very long time. 2030s maybe, 2040s, a really long time. And that's why they have to keep the short-term rates down, because the long-term rates just aren't going to go up. And that's kind of driving a new real estate bubble, in my opinion, because incomes to real estate prices don't make sense. If we get a recession and unemployment goes up, a lot of these 2-income households that have overbought their real estate, when somebody loses a job in those 2-income households, they're not going to be able to keep those $600,000 houses in Milwaukee or the $2 million houses in California or whatever. There's just too many pockets where real estate prices have gotten too high. So the big thing is in interest rates, it's quantitative tightening. In September, quantitative tightening goes away. And that's $50 billion starting to go back into the economy every month, right? That's a lot of money over 12 months. That's largely why the market has been challenged for a year and a half. It's had the rally first half of this year. So when quantitative tightening goes away, I really do think Q4 could be pretty darn good. And even into Q1. At some point, it becomes dependent on the economy again, though. So over the summer, you have low volumes. That means the markets are going to trade thin. They could jump up 10%, they could fall 20%. Hard to know. My guess is we get a little summer correction and that it's worth buying. And whether we buy in September or October, or exactly where we buy, I'm not sure yet. My guess is sometime in September. We will probably see an asset allocation shift that's more aggressive. But right now, I like to be conservative. The whole sell in May thing usually works out. July and August, we're seeing a record number of corporate revisions downward. 80%. 80% of corporate revisions on earnings have been downward. That's huge. So we could see a rough patch here. Trying to figure out exactly when things will happen, though, is tough. Market sometimes anticipates, sometimes it reacts. It all depends on sentiment. Cash allocations. Look at this. Pretty low. So I think that we're smart to be having more cash than most people. We'll see how it goes. People raise cash into the correction, right? Because they're losing money, so they sell at the bottom. But they're buying at the top, right? They bought at the top. We want to be contrarians at a certain level. Take a look at the Fed funds rate. Alligator jaws you got to watch out for. But take a look at this article and try to read it. Commodities are super cheap and out of favor. And as I told you, capital cycles matter. Investment in commodities, whether it's metals or fertilizer or oil and gas, are just not that high. Cobalt, I think they're going to start finding more and more replacements for cobalt because they're trying really hard to do that. But zinc is interesting to me, right? Because some of the new battery technology is based on zinc. Iron, It's rallied a bit. I don't think that I'm in love with iron, but interestingly, Norway, in all of its, somebody put this up. I don't know where it is. Oh, that's not it. But somebody put it on one of our message boards. That Norway took some companies off of their ethically restricted list. Rio Tinto was one of them, and their iron ore, and Nutrien, a stock that we're in, came off the Norway restricted list. So if Norway's buying Nutrien and Rio Tinto and a few others, probably could see a pop there. We saw what happened to oil stocks when Norway sold. So, the hypocrisy of the Norway sovereign wealth fund, formerly called the oil fund, is kind of amazing to me. Is that they would invest tons and tons of their money in oil stocks in the past, but Nutrien, which was potash company at one point, they had some operations in the Sahara, that were questionable. They were buying from some people who were doing some things that were questionable. Gets them on a restricted list. I tell you what, the guys who run the Norway fund, the hypocrisy of some of the Northern Europeans, and I know people love to say, oh, look at Northern Europe, they're doing everything great, they're socialist. Nah, bullshit. They have made their money on things that they say are repulsive, but they enjoy the standard of living. So, what is the line from is it Young Guns? Doc Holliday? My hypocrisy knows no bounds. Yeah, I think there's a lot of that in investing. So, all right, let's wrap it up here. Oil inventories continue to come down. There's just another draw. But then you see them put out numbers like this that oil inventories have gone up. Not really, because it's been natural gas, liquids, and propane. Oil inventory has been falling the last couple of weeks, and it's been dramatic. And the builds were lower than in the past. So while we're getting a lot of natural gas, liquids, and propane, oil is not, there's constructive results on oil inventories. Now, will it be enough to raise prices and get these stocks moving in a better direction? We'll see. We need the economy not to slow down a ton. Got some notifications. I'll take a look at those soon. I subscribe to Oil and Gas 360 so that you don't have to. And they did a pretty interesting report on oil and gas funding evolving. The long and short of it is that the banks are starting to wise up a little at a time, but private equity and other investors are really, really wising up. So we'll see if we get that wave of super small cap, small cap and wildcatter bankruptcies and takeovers, take unders. I think there'll be that will tighten up that market even more. It seems like it'll go in that direction. The one fear that we should have as oil stock investors is that the big banks keep the zombie companies alive. The big banks would be smart to let the zombie companies go into bankruptcy and reorganize, kill the shareholders in those companies. And I'm talking your 50 and 100 and $150 million companies, not stuff that we're in. But those little companies, they should kill the shareholders, call in the debt, seize assets, sell them to Chevron or whoever. That would be the smart thing for the banks to do, because there just is no future in those little companies. All they're doing is trying to operate the margin, and they're making it harder for other companies to operate the margin. So the super small oil companies should be sacrificed to save the mid-size and large companies some grief, and to make that industry strong and profitable again. And there's been a move in that direction because they've all tightened their belts. We saw what Pioneer Energy did, cutting 25% of their labor, right? They cut 25% of their salaries and expenses, their labor expenses, following in the footsteps of Concho. So the industry is moving in the right direction. However, there's clearly the sentiment problem. There's the divestiture movement, and you've got these companies, these zombie little companies that are making margins difficult because they're adding several 100,000 barrels a day. Those are the several 100,000 barrels a day that we need to be gone to tighten up that market and make it more efficient. And then Saudi Arabia fills any gaps, and that's just fine. They have the oil to do it. For solar, we were buying it down in here and back in here. I trimmed it up around 60, and it's even, it's, still doing. I think we may have sold a little bit of it around 70. I don't remember. I'd have to check the dates. But look at that. That's a pretty constructive chart. I want to see it get back to about this level, just under 50. And I load up the bus, load up the truck, load up the van, load up pickup truck, all of it. Why First Solar? Because the movement towards solar utilities is huge. You're seeing coal power plants torn down and replaced with solar and wind, mostly solar, about 2/3 solar. Happened in Indiana, a state that nobody would have thought. There was just news out of California. I'm trying to think what exactly that news was. It was another power plant getting built. I don't remember if there was a coal power plant getting torn down, but there was another coal power plant that they're saying they're going to get rid of, like in Ohio or something. The coal power plants, even without legislation, are probably all going to be gone in the next decade. And I expect legislation at some point that just says, hey, coal's got to go away. And they'll do it by restricting financing. They'll do it by restricting exports and by putting requirements on the utilities. So there's all sorts of executive administrative actions that can take place. A new president could order, just like they did with oil years ago, order that there's no exports of coal. Now, eventually, Congress backed that, but you can do that by executive order. So we'll see. Sun Power, which was one of my recommendations. First Solar dominates utility solar. Sun Power is the leader in commercial. And we've been buying that in the 6s and 7s. And we finally got that big jump up. Now, I had a lot of mine called away at 10. So, that kind of sucks. But I had premium. So as it gets back down to 10, and it will, at some point it will, as corporations are tighter on money, as they try to reduce debt, and this will be a cyclical thing, the next time that there is a belt tightening in corporations, that'll probably impact Sun Power. And you'll get all the people talking about how solar sucks, and that's when you buy. So I continue to sell a lot of puts on Sun Power at 10, hoping that they get put back to me. But I'm happy with these premiums because Sun Power premiums are very high because it's a volatile stock and it's kind of a battleground stock. So when it was 6, I told everybody I think it'd be a 10 bagger from 6. Do I still think it gets to 60 or 100? Yeah, I do. I think that, looking at real estate as an investor, which is what I'm doing now, it makes tremendous amount of sense to build solar in the buildings. Maybe not necessarily to power an entire building, but to do some of the energy. So your daytime energy. It becomes very economical if you don't have to store the energy. Now, if you're trying to do storage, it's still kind of expensive. But if you just want to use the sun's power during the day, however many days a year that you have sunshine where you are, it's pretty economical. It makes sense to put solar on top of commercial buildings if you're not buying batteries. Now, I think there's a reason to buy some batteries, for emergencies, but we'll see. I think I think we're going to continue to rebuild the grid, even if we do it piecemeal like we've been doing. My Vegas trip here that several people said they don't really want to hear about anymore. I was with a guy who's hangs transmission lines and puts in the transformers, and they've been doing a lot of pretty high-tech stuff with the grid. So, we continue to move in that direction of updating the power grid. We know that grid security is important. That's an investment theme. We know that electric vehicles are an investment theme. We know that the momentum and the curves are all turning the right way. So, if you're not subscribing, look at that, I wasn't subscribing. I actually read their website. But ARK Investment Management, they do good work. And this is one of the ETFs that we buy, right? We buy ARKK and ARKW. I like ARKW because I'm not all that excited about the biotech. I think those have to be picked out company to company. But you take a look at what's going on here. If you didn't know what this was, right? If you cross this out, but you saw that, okay? So cross out global battery electric vehicle sales. Somebody just said, "Hey, I got this thing," and look at the growth curve, and it's still cheap now. You'd be pretty excited. So, I like Tesla. Like I said, I think it's going to 1,000 or higher sometime in the next decade. I can live with it not going to 1,000 tomorrow. It goes up fivefold for me, fourfold for me over the course of a decade. That would excite me. So, all right. Why don't you fire out a couple of questions, and then we're going to call it a day, and you can go enjoy your weekend. Anybody got anything? No? So, I gave a little bit of a forecast when I said that I thought that we should be buying any summer correction. I think I'll stick with that. I think the QT is what people are missing. When they end quantitative tightening, I think that adds a charge to the market for the fourth and first quarters. So if you want to do that sort of trading, you can. I think the easiest things to buy will be QQQ. And maybe if you want to buy some of the ARK funds, go ahead and do that. I think you should be looking at that Malaysia. No, don't buy calls. Don't buy calls unless you can take that risk. These aren't easy trades. Calls are meant for easier trades. And we thought we were making some easy trades, and they turned out hard and we lost money. Calls are very hard for people to use unless you have very good technical skills and the willingness to take your profits incrementally, quickly sometimes. I just think calls are tough for some people. But, if we get a really deep correction, right, let's say there's bad news with China and the stock market drops 20%, then calls can make some sense, right? You want to look for the easier opportunities to employ leverage using calls. And why would that be an easy opportunity if China decided not to play nice? Because the overreaction would probably be pretty significant. And the reality that I've talked about is that global trade and global growth are less correlated now than they were in the past. Why? Because of machine learning and because of activist central banks. So look for the easier opportunities. You don't buy calls on a 5% pullback. You buy calls on a 20 or 30 or 50% pullback. I don't think we're going to get a 20% pullback in QQQ here. But if it happens, then yeah, sure. Then calls make some sense. Does that make sense to you, Michael? Did I explain that well? Good. All right. Look for the easy things on calls because time value works against you unless you're the seller, right? And that's why I like selling puts because time value works in my favor then. All right. Everybody have a great rest of your long weekend. We had a little light turnout today, only about 30 folks, but everybody stuck around, so that's awesome. no more poker stories for a while. I actually had 4 or 5 people say, I just don't want to hear about that stuff. I don't know. I think it's kind of interesting. And I thought there were correlations to investing, and I'm not the only person who's made those correlations. So it's a learning tool, right? It's a learning tool. Take a look at this article from Top Down Charts. I think it's a really nice summary. I'm going to have something similar out over the next couple of weeks, but I'm going to break a lot of these things down into their own articles. I'll talk a little bit more about them in depth. Get the sustainable growth stock list out there. And I want to finish those 2 reports that I started. And I haven't finished yet, so I have to get those out. Otherwise, if you are not a subscriber and you hear this, contact me on Margin of Safety if you'd like to subscribe. And I have the ability to give a first-year discount. Just ask for it, and I'll give it to you. But other than that, I think that we are back in the right direction real nicely. I think that our asset allocation is right. I think we've taken all the pain that we can possibly take on oil. And as we get some of that back, we'll rotate out of those. Maybe we trade them in the future once or twice. But in general, I think the world is moving away from fossil fuels, and the market's anticipating that. And there's an awfully large divestiture movement that's not going to get any smaller. So energy investing is going to be tough in the future. Like I said, there'll be some trades. I think that we probably see some take privates in the oil patch. I think the executives and private equity take some of these companies private, and there'll be a small premium involved, but they're beaten up so much that who knows if they get back to where we need them to get back to. So, one thing that the divestiture movement is doing is giving the executives an opportunity to seize the assets of these companies for themselves. And that sucks for investors. And really doesn't satisfy the goals of the divestiture movement. The divestiture movement really has been inconsequential to policy. But they've hurt people. And they've prevented a pipeline that could have made us free from OPEC. The article I'm writing on Monday is titled "Freedom from OPEC is a Pipeline Away." And I'm going to talk about the pipelines that didn't get built and what the real consequences are, both positive and negative. The positive is that existing assets are worth more. The negative is that we stay engaged in a Middle East that doesn't want us, that's expensive to deal with, and costs lives. I mean, it's horrible. So, I don't think anybody could argue with me that not building 2 more pipelines, which is all it would take, there's 2 of them out there that could be built, to get us torn away from the Middle East dramas that we're involved in is a bad idea. Yeah, great. I want us to move away from fossil fuels too, but the reality is that'll take several decades, and why would we fight wars in the Middle East and engage in things that just have been horrible? So that's my freedom message, is that sometimes something that is undesirable is still more desirable than the alternative. All right, have a great weekend, folks. Thanks a lot.